Welcome to Lesson 3. Today we're covering types of assets, because choosing where your money lives is the first real decision in investing. Savings accounts, stocks, real estate, crypto, each one sits at a different point on the spectrum of safety versus growth speed. The one principle we'll lock in today is simple. The safer the asset, the slower it grows, and the faster it can earn, the more risk it usually carries. Once you understand that spectrum, picking assets that fit your situation gets a lot easier. Here's the most basic law of investing. Safer assets grow slowly, and assets that can grow faster can also lose a lot more. For example, a typical U.S. savings account might earn roughly 0.4 to 0.5% a year at a traditional bank, or around 4% plus at an online high-yield account, with almost no principal risk. 비트코인, 바이 콘트라스트, 큰 점프 30, 50%인 AE몬스, 오르드로 50, 70%. On the left sit low-risk assets, savings, treasuries. On the right sit high-risk ones, crypto, like Bitcoin, leverage. Stocks, real estate, and commodities sit in the middle, each with its own risk-return balance. The key point, chasing only high returns is not the answer. First, decide how much loss you can actually tolerate, then choose assets inside that range. And don't put everything into one asset. Spreading across several is how you bring overall volatility down. That's the core idea. The safest assets are bank savings and government bonds. In the U.S., FDIC insurance covers deposits up to $250,000 per depositor per insured bank. So even if your bank fails, that protected amount comes back. A bond is a promise. I'll borrow your money and pay you interest. The U.S. 10-year Treasury yield on this chart is the clearest example. When the government makes that promise, it's as solid as it gets. But because they're so safe, they grow slowly. In today's environment, roughly 3 to 5% a year is already solid. Think of it like setting aside about 5% of your paycheck every month. Steady, not spectacular. Inflation creates a problem. If prices rise faster than the interest you're earning, and remember the Fed's long-run 2% target, plus the 2022 spike near 9%, you can lose purchasing power even while the account balance goes up. So low-risk assets alone have limits for long-term wealth building. You need a balance between safety and growth. Stocks are pieces of a company. Looking at the S&P 500 on this chart, when companies grow and earn profits, you can benefit through dividends or a rising share price. Historically, holding a broad stock market for 20 years or more has usually beaten inflation. But year to year, it can swing hard, like a long-haul flight ticket with a locked-in price versus a last-minute fare that jumps with season, weather, and fuel costs. Real estate means owning something physical, a building or land. Supply is limited, and you pay ongoing costs, but over long horizons values have tended to rise. Commodities like gold and oil often rise when inflation heats up. During the high inflation stretch around 2021, gold and oil both climbed, which is why investors use them as a hedge against rising prices. Stocks and real estate are the core holdings for many adult investors. What they share, their growth assets, their value tends to build as time passes. Bitcoin on this chart is a classic high-volatility asset. Crypto can rise or fall 30 to 50% too in just a few days. In bull runs like 2020 to 2021, Bitcoin roughly tripled in a year, but in bear markets, it has also dropped 70 to 80% too. Check that history on the chart yourself. Leverage is even riskier. You're trading with borrowed money, so gains can be 2x or 3x, and losses scale the same way. In extreme cases, the whole account can be liquidated. A conservative guideline is to keep only about 10 to 20% of investable money in assets this risky. Age, income, and risk tolerance still change that number a lot for each person. The bottom line, putting serious money into something you don't understand isn't investing, it's gambling. Asset allocation means spreading your money across several types of assets. It's the old eggs in one basket idea. Drop one basket and every egg breaks. Split them across several baskets and you cut the damage. In practice, bonds can rise when stocks fall, and gold or international assets can strengthen when the dollar weakens. That offsetting pattern is called negative correlation, and it's the heart of diversification. Age is one reference point. 소문인데요. 20의 스마이트 스타트 유로플리 20% CFSH, 70% 스톡스, 인두 10% 하이어 리스크. 소문인데요. 50의 스마이트 린 투어드 어바웃 40% CFSH, 45% 스톡스, 인두 15% 반지즈 아스 이 베이스라인. But age matters less than 3 clearer questions. How long will I stay invested? What's my dollar goal? How much can I lose without wrecking my life? The single most important rule, don't go all in on one asset. The same $10,000, properly diversified, usually rides through market swings with far less volatility. Let's wrap lesson 3. First, every asset sits on a safety versus speed spectrum. Safer means slower growth. Faster means you can lose more. Second, savings and treasuries are safest. Stocks, real estate, and commodities sit in the middle. Crypto and leverage are the riskiest. Third, don't park everything in one asset. Spreading across several can reduce overall losses. In Lesson 4, we'll look at how markets actually move, demand and supply, the order book, liquidity, and the hidden mechanics behind price. This course is for education only. Nothing here is investment advice. Every trading decision and its consequences are yours alone.